All right. Good morning, everybody. It's OpEx today, and we're going to get some Fed speakers. CrowdStrike Holdings, which is an antivirus for cloud computing, sent out an update that knocked out a lot of services, and that sent tech back down in the overnight hours. They say it wasn't a hack. They just screwed up somewhere in the update cloud, and it was causing the blue screen of death, which is kind of some old school talk right there. If you haven't been on computers for 30 years, you may have never seen the antiquated blue screen. Netflix had mixed numbers. They're going to quit doing their subscriber numbers in 2025. They're just going to quit reporting them. But now that they've fully embraced ad revenue, it seems like they're just going to continue to do reasonably well. But they didn't hit all the numbers that they were projected to hit. So US small caps, S&P and NASDAQ barely in the green. The Dow down 0.25%. Hong Kong basically flat with Japan. A little more weakness in Europe, down about 0.5%. After we're done with the Bostic today, we should be just done, other than OpEx, of course. OpEx is options expiration. It happens every third Friday of the month. So it shouldn't sneak up on you. And there was a little oddness out of Microsoft last night. They say they had their own issues. It wasn't necessarily that CrowdStrike was causing Microsoft issues, that it actually had its own, but they were deploying cloud-based solutions to the CrowdStrike issue, along with solutions to whatever their own issue was. So it's kind of a twofer. It's interesting I'm really interested in finding out what they did, who screwed up where, because if it's not a hack, then this is someone who dropped the ball. Airlines and drilling companies reported today, not all of them, but a number of them. I've worked on a number of those drilling companies over the years. So far, we have an MDP that's a missed daily pivot. We haven't hit it. That means we missed it, right? We're not doing what we have normally done 80% of the time, and that would be hitting this pivot. And MDP really doesn't count today, though. We would use it the next day, right? So like back here where we didn't hit the pivot. Okay, maybe we did. No, we didn't hit it. So on a day where we didn't hit the pivot, we would look at the next day as the day after the missed daily pivot. It's not a strategy that I trade necessarily, but it does provide a little bit of insight. It's not mine either. If you were to go Google missed daily pivots, or say look it up on YouTube, you would find quite a number of videos on it. Most of it focuses on, like daily charts and weekly, but it provides some insight on how you can use pivots a little differently. And from an analysis standpoint, gives you a better idea of what price should do on a day-to-day basis. And then when it's not doing what it should, it stands out, right? It's doing the other 20%. Still don't have the spot gamma founders note for this morning for the AM edition yet, but last night, if you read the PM edition, it showed the call wall rolled up to 57.50. The put wall rolled up to 5,500. So it's really close to us now. Remember, it was down at like 53. It's now at 55. So there's a put wall right here. And zero gamma dropped down, or the gamma index. The volatility trigger stayed flat, and it is at 55.95, which is really close to us, right? We've been cutting through 55.95 a few times here. So really close to 55.92 cog line. And it's often considered a very significant support. If we break that, the 5,500 put wall is like the last hurrah. We break below that and we could make some really quick, fast moves down to 53. Easy. No problem. The spot gamma index is at 0. And remember, that thing goes from a 4 to a -4. So if we're sitting at 0, we're right at the middle, right? -4 says if we break out, we're going to expand considerably. And a +4 says if we attempt to break out, it's very likely going to fail. It's very much, those two numbers are very much like our central pivots that we talk about every day. If it's a very narrow range, we could break out and expand. And if it's a very wide range, then the expectation is if we attempt to break out, we won't expand very far. Penning is a fun word. In the founder's note last night, they said we have a lack of a pen right now. They actually used that word and that language. So I know the PM edition is one I don't necessarily read every day, just to be fair. But if you didn't read last night's, probably want to do that. We don't have a pen today for OpEx. At least we didn't have one last night. And that's really what stood out to me in the PM edition notes was that they're like, okay, we don't have one. So yeah, good luck with that. Maybe in the AM notes today, they'll provide some context, right? Because right now we don't have one. It's unusual to go into OpEx without a big level that we can focus on as a pin. There are things called max pain. I don't really apply max pain to the futures though, right? Like yeah, I don't see how max pain applies for futures. I could be wrong on that, but I've never found any value in it. We're developing a new D down here on the week. We could just stay right down here in this lower section. We're not expecting to really go anywhere, right? Since we don't have anything that can draw us like a magnet or a pin in any particular direction. More of, say, a hold the line sort of thing. I don't have any volume in there. That's odd. Thinkorswim does some odd stuff sometimes. And we'll figure that out later. So it is possible that we stay in this really tight zone, 55.75 to 56.25, 50 points. Yeah, I tried that. It didn't work. And it didn't reset itself because I had removed orders so that I only had bid and ask. And if it was going to reset itself, then those would have showed up too. Load defaults. See if that works. Nope. Who knows? Thinkorswim in all its glory. There is just a lot of software and tech issues. Speaking of, the internet provider that I use will be at my house today. So if I drop out through the morning, that's their window between 8:30 and noon. You'll know why you're not hearing from me. It'll be because I'm sitting on my hands while somebody is in my office screwing with my equipment. These are anchors and VWAP anchors for a monthly valuation. So the one in red is July. We're below the July anchor. June is right below that, 55.22. These don't really seem to be much that the futures respond to, but it is a good value idea, right? Just kind of keeping an eye on it. The monthly is all right. The yearly is the one that I really pay attention to, where we're at on the year, above or below, right? And some of these, they just get tangled together. It's just noise. Definitely want to keep them on their own chart so that they don't become a distraction, because it could get really sloppy and nasty. Looking at the daily, we're at that 20 period moving average. We struggled with it for 2 days now. Well, yesterday and today. This isn't the final line in the sand, but if we're going to be bullish into this next quarter, we kind of need to keep it. Once we get below it, it takes a while to get back up there, right? We're talking a month or so. We got QRA coming up in like a week and a half with an FOMC announcement behind it or with it. I don't think we can afford to go underneath that 20 for the whole quarter, right? And that's, I mean, it would take quite a bit of time to get back up through it and, kind of come back around again. So we're getting close to a line in the sand. From a pure price method, we're not in a downtrend. We have to break this low back here, that 55.25 that I mentioned a moment ago. Until we break that, we don't have a lower low. Now we can set a low here, which would be a higher low, and we can run up and set a lower high. That would give us our first lower high. Then we would need to cut this low and make a new low, and then we'd have a lower high and a lower low, which is one set, and we need 2 sets, right? So we don't have any sort of trend to the downside at this point. That's using price. Others use moving averages, and they'll use something like a 50 and a 20 period. As long as we're above the 20, then the trend is completely intact. If we're underneath the 20, the trend is at risk or, a threat. And then, of course, you get below the 50, the trend is dead. Or you could say that we're in a downtrend instead of an uptrend. Some analysts say you're always in a trend, whether it's up or down is debatable, but that there always is trend. I'm not necessarily a fan of that statement, but either way, we're not under the 50. We don't have 2 higher highs and 2 lower highs and 2 lower lows. So from a pure price method, we're not in a downtrend. And from a moving average method, we're not in a downtrend. We don't even really have a topping pattern here, right? We just got a decent pullback. A nice, really good pullback is around 5 to 7%. Those are the ones that historically we tend to try to grab a hold of from the buy low, sell high, catch it on a pullback trend trading concept. And we're not even down 3% yet. So it's not time to buy the dip either, because we could get another 2.5% lower. We could get down into that 5,500 area, that 50 period moving average. Still, we're not worried about a crash and burn or anything like that. Just a good, healthy 5 to 7% pullback like we had back here. Really, that's all we're talking about. But we don't have confirmation that we're even going to do that yet. So don't run out and try to trade a bunch of stuff short. Don't load the boat yet. Looking at last week's price, sure, we're outside of last week's range. We've expanded a little bit to the downside, but we've pulled up off of that bottom quite a bit too. There's a couple of things that we can analyze here. From a 50% point of view, this breakout bar from the range that we had here, this IX10 breakout set to 50. We didn't get below that one. If we measure last week's range and give ourselves projections to the downside, that's the wrong tool. We didn't make 50% there either. And if you didn't catch those numbers, the 50% from this week and the measured move of 50% from last week, they're basically in the same spot. You could consider that a little bit of support. Support that we haven't even tested yet. Yeah. Because near doesn't count. This isn't horseshoes or grenades. I've added something to the top up here. Every day we look at the average daily range. This is a simple average of the last 21 days. And from that simple average, we get the red and the yellow lines, the ADR lines that I love and use every day. But there's a lot of ways to define or calculate how far a market should move in a given period of time. It's a square root formula. It sounds complicated, but really, like any other math, once you understand what it's doing, it's not really all that complicated. The thing is, there's a lot of ways to accomplish this task of asking how far should our market go today if it's going to do a normal thing. That's where the daily expected move comes in. So this is a square root formula using volatility and a few other metrics. It's very similar to looking at this line here on the average implied volatility, right? It's very similar to this right here. Only it's just for the day, right? 1 day expected move. This other number, so one standard deviation. It's a little more complicated, but it would be more akin to using this and setting your probability to 1. So one standard deviation right there. But that also is an expected range measure. How far should we go if we're just going to do what we have done on average? If you were to try to look this stuff up, it would seem in the pictures, most of the pictures would have some sort of bell curve here. And then there would be the midpoint and the 60% level. And that would be your cone for your one standard deviation. That's what this is. It just doesn't have that rounded top and it's not showing the tails, right? That's it. It's the same thing. So we have those levels now. It gives us something that we can use to benchmark against what the average daily range is. We can see that they're hedging this morning, and we've got some pretty significant volume, all things considered. Remember, we've been seeing 40s, 50s, and 60s. Now we're seeing 120, 140, some serious numbers, and they're hedging. Typically, we do one or the other. We get a lot of trading volume in the pre-market, or we get some hedging in the pre-market. We don't generally get both. Now, remember, we were just looking at what we have on the table today. What the heck are they hedging for? Canada's retail sales? It's possible. I don't want to say that it's not, because I wouldn't think so, but there's nothing else on the table. Williams isn't enough to cause them to hedge. So I don't have a good answer. The good thing is, even if we don't know why they're hedging, we know that they are hedging. And that's the key. We don't have to understand why they're hedging as long as we know that they are hedging. And they are hedging. That is not in question. So what we do with this number, say there's that statistic right now about the S&P not having made a 2% move in like forever, right? I don't even know how long it's been now. It hasn't made a 2% move in so long that it's starting to break records on how far it's been, how long it's been since we've made a 2% day. If we were trying to calculate an outsized move today, this metric comes into play. We look at the yellow line from the ADR and we add that market maker move to the upside and we subtract that from the downside. So instead of 55.50, take another 25 points off. That lines us up at 55.25 to the downside. And instead of 56.55, it would be 56.80 to the upside. At that point, we're still talking about a normal day. I know it sounds wild making those kind of moves and calling it a normal day, but it would still be a normal day. That isn't the outlier yet. That's just a normal day at the office. At that point, if we break those levels and we want to ask, well, how much farther could we go? Take both of those numbers, which is 75, 50 on this one and 25 on this one. And from the high point that you already had, apply another 75 to it. And from the low point you already had, apply another 75 lower. That's how far we could go in an outlier event today. So from 55.25, you're talking 54.50, right? Today, that's the kind of move it could be. And it is a plus or minus. No matter how negative it might feel this morning, we could just as easily make that move to the upside, right? You're talking 150 points, 140 points total from where we opened it last night in Globex in a day. Yeah, that would be an outlier. But if you were trading during COVID, you know that we can make those sort of moves because we've done it before. The lock limits is 7% in a day. And we triggered lock limits intraday trading during COVID. So we were moving 7% in a day. We just talked about a 6.5% pullback here that took 4 days. How about moving that far in a single day and triggering lock limits? Because that's what we were doing during COVID. So 150 points in a day compared to that is not really much to sneeze at. Continue to keep your eye on the market maker move through the morning to see if it starts to diminish, because since we don't know what it is, we don't know what event to keep our eye on. Once it starts to diminish, that'll tell you that whatever event it was hedging against has happened. I think price alone is going to tell you, because whatever it is they're hedging against very likely is going to cause a move, just like the move we see for PPI, CPI, non-farm payrolls, those kind of moves. I think you'll feel it. But if we don't, and you start to see the market maker move diminish, then at least you'll know that we're beyond whatever threat it was that they were hedging against. No, I don't know. That's okay. I'm not scared to say I don't know. They're hedging against something, but I don't know what it is. But it does prove my point that I continue to say, we look at multiple websites trying to look at the different economic events that we're going to get today. And even with all of these different websites, it's not every event. It's probably half or a little less than half of all of the events that happen on an average daily basis. A lot of them just don't get listed. And you may think, well, it's not listed, it must not be important. QRA isn't listed, and that's a really important one. And if that one's not on there, what else isn't on there? So we are now firmly below that point of control that we talked about, 10-day, 30-minute. I had mentioned if we kept just chopping around, then we could keep coming back and forth. But that once we expanded far enough away from it, it would then become a resistance. And well, we've got that. So we now have that 5640 point of control overhead that is very likely going to be a resistance for any upside move today. Econ doesn't care about pivot points, fear and greed, the algos. If we get some sort of extraneous news today that pops us to the upside, this pivot point will not be taken into a consideration. Price will run right through it. I carried forward that point of control yesterday. I said I wanted it on my screen just to see if we were to come back to that level. When we moved through it to the downside, I almost took it off then because we cut right through it like it wasn't even there. But I left it on just to see, and we did interact with it on the way back up. And in this fall yesterday, I remember speaking with somebody, and they were talking about how this move where we bounced back up had thrown them off because we had confirmed that it wasn't a double bottom, right? You know how we talk about double bottoms are bear traps. And if it goes deeper than a 1, 2, 3, 6, then it's not a bear trap. It's an actual continuation lower. Well, it did that. It went below a 1, 2, 3, 6. So the person went short here. And the comment I made was, yeah, but if you rip down there really fast, then, you get this sort of bungee cord rebound, mean reversion sort of knee jerk reaction back the other way. And they said, well, we didn't do that. We didn't rip down there really fast. I would beg to differ, though. I mean, it's not a wick, right? It's not one of these where you get this big wick down and then we just shot right back up again. But that's a waterfall event on a different time frame that'd be one-time framing. Look at the size of that one single candle. It's bigger than any other candle in the entire trading day from where we opened the previous night at 6 o'clock. That's a liquidity gap, by the way, right? That's like a CPI candle, PPI, non-farm payrolls. It's one of those kind of candles. So when you move that far, that fast, you're very often going to get some sort of knee-jerk mean reversion. And our 1, 2, 3, 6 and trying to confirm that it's not a bear trap sort of approach doesn't fit, right? It can't apply that logic when you get that fast of a move. So it's not that the person was wrong for trying to identify, is this a double bottom or not? And once we went through the 1, 2, 3, 6 saying, nope, it's not a double bottom, because it wasn't, right? We kept going. It wasn't a bear trap, but you got to kind of be prepared for this knee-jerk reaction where it tried to go back the other way. Why? Because it was trying to fill that gap. And when you look at how far it managed to bounce back up to the halfback, a perfect halfback rejection. Doesn't get any better than that, right? Love those halfbacks. We don't have a VPOC to carry forward from yesterday, but like we talked about yesterday, carrying forward just a regular point of control can have value. I did it carrying Wednesdays into Thursday because of this profile being a lowercase b with the point of control down here. It's not exactly what we had yesterday, which is more of a B shape profile. B's are really just 2 D's with the profile in the lower section. It's different. I'm not going to carry this one forward. It's not a VPOC, and it's not a profile that I'm really interested in. Doesn't mean you shouldn't. Certainly could. We are outside the week's range. Got some context there, right? We want to look at the week that we just had and compare it with next week's range, which is not set in stone yet. These lines are going to move through the day today, and they'll lock into place tonight after 4:15. But we get a glimpse of the range for next week, and we can measure our week and put it into next week's range and ask, is the range for next week bigger or smaller? Well, looking at this, it's bigger. It's considerably bigger. These ranges are derived by time and volatility and some other metrics that are tossed in there too. So it has a square root of time formula built into it. It's using volatility as another metric. And so if volatility is increasing, these boxes will get wider. And if volatility is decreasing, the boxes will get narrower. Whatever's on the table for next week has the market in a juiced up volatility state because the box for next week is bigger. Both of these are a 5-day week as opposed to, you know, say the 4th of July week where there was just 4. So it's a 5-day trading week on both of these. That means the square root of time on both of these is the same. The only thing that changed between our current week and next week is the volatility, which is why the range is bigger. So the events that are on the table for next week, whether it's earnings from big companies, economic data points, combination of those two, the market is pricing in more volatility for next week. So on the top of that door, I mean, as long as we continue to close above it, right, then you could have a consideration that it might be providing some sort of support. Here's day 1, day 2, day 3. So this would be like a big Busby that we broke out of the zone. We came back and we're resting on that 3-day door. And as any other support or resistance, once we close below it, but we got to think about it just like that point of control on the 10-day. As long as we're crisscrossing back and forth, it'll act as a support. Once we get, quote, far enough below it, then we try to come back up at it. It'll be a resistance. But how far below? Just no really good way to quantify it. Obviously, it would have to be lower than these because we went at least this low and we were able to get back above that line. And we didn't close that low, right? We just went that low and we came back up. So whether it's the round number 5650, whether it's just getting lower than these and closing below it, as long as we're still chopping back and forth through it, we'll still count it as a support level. We're still 2% above the 10-week. So we're still in that sweet spot. Considering how long it's been since the last reset, we could actually get all the way back to that 10-week. If you're unfamiliar with the correlation between a 10-week and a daily moving average, the 10-week is akin to the 50-period daily. So we're talking about the S&P getting all the way back to the 50 daily. Now, we don't have that yet, but we haven't had a good reset in a while. From November, when we got QRA and everything changed and we ran all the way to April and we didn't get back. Then we got a nice reset and we've been running again since April. And I don't have well, I guess I do have them on there. We got the quarterly lines up here when the quarter ended. And it doesn't really seem to line up perfectly with that. Like this one, we got a new quarter. Well, I guess you could say we were on the decline, right? We got a new quarter. We kind of stalled out and declined. We got a new quarter here. And for the whole quarter, we held it. And then we immediately dumped. We got a new quarter here and we immediately dumped. On this one, we got a new quarter when we were negative and we immediately went up. So getting a new quarter is where we change the narrative. Oftentimes it's where funds and firms will take a different approach, right? They'll rotate out of what they've been doing for the first half of the year, say, for an example, and they'll start doing something else, especially if they're underperforming and they're lagging behind their peers. So things were looking good. We got a new quarter. We're on the decline. We could get all the way back to that 0, which would be like getting to the 50-day. Looking at the daily and how far we are from the 10, we're underneath it, more than 0.5%. That's usually where we kind of wrap things up on the downward side. Obviously, if we're going to get, say, a 6.5 to 7% pullback, then we'll get farther away from that 10-day. But if this is just a minor pullback, then getting less than 1% underneath that 10-day is about as far as we go, right? That's generally what we have done for this year. If we look back farther, we can see the average. It's a little deeper than 1.5. But for 2024, we've been holding pretty steady underneath the 10 at less than 1%. That would imply that we're likely to pause here, consolidate, and or immediately begin working our way back up on that shorter time frame, getting back above the 10. But we don't have to go to the 10, right? It can come to us. It's been a pretty eventful week. Some of our defensive names like utilities and healthcare over a 5-day period, they're still in the red. Staples is up, 1.5%. Energy more than 3.25%. Tech down more than 3%. And financials are still up 2.5%, but they got a little bit of a pullback there. This change in healthcare and staples, it doesn't bode well for a broadening out of the rally. If we get tech down and we get everything else down, then we're just going to go down, right? There'll be nothing left holding us up. Now, we had started to see a little bit of a tech comeback yesterday, right? The bounce off the 50, the rise back up, and that would account for, these getting whacked like healthcare. But then we got this issue with CrowdStrike, which I think maybe Palo Alto may step in to pick up that slack, right? I found an article. I didn't get a chance to read it yet because I had to do the briefing. But if CrowdStrike is now the unfavorable one, who's going to take its place? It's a small peer group. I think Palo Alto comes to mind as a comparable peer. So really want to keep your eye on all 9 sectors throughout the day to day. See how the week closes, and then look at them on that weekly chart and kind of evaluate where we're going to go from here. Because if we drop the ball and we don't get this broadening out and we continue to have weakness across the board, well, then, I mean, we're going to get that 5 to 7% pullback. Gold miners are down the most, jets, uranium behind that, then retail and biotech. Biotech's been doing really good. It's getting kind of whacked recently, but I mean, for the year, cloud computing, gold, man, everything, transportation, banking, China ADRs, metals and mining, solar. It would almost be easier just to say, what's up? What's up? Home construction and Russell volatility, the RVX. Think of that like the VIX, right? The VIX is for the S&P. This is VIX for the Russell. That's up. And that makes sense because they're still calling for a Russell short. Bond volatility is also up. That's what the MOVE index is. It's VIX for bonds. Bitcoin is up. And the dollar's up. Which makes sense because we've had the dollar make some pretty crazy moves. Very nice. PANW up in the pre-market. Yeah, but it's struggling, isn't it? I mean, it's been doing good anyways. It's above this halfback level, and it's above its year-to-date anchored VWAP. For the week, I would want to see something a little more out of it. But yeah, if CrowdStrike's going to get whacked, then it would be interesting to see who's going to step up, take its place. Pot stocks are up this morning as well. So Bitcoin, pot stocks, you don't want a rally led by Bitcoin and pot stocks. Cloud computing, but that one can often just be, a little bit of a algo print. It's not, because we can see this big candle here. It's likely that cloud computing is moving this morning, tied directly to CrowdStrike and its issues with cloud cybersecurity. Kind of makes sense. MSOS is pot stocks again, and then USO. This one's up, but not enough. We need a little bit more out of it. Once it's up 0.5%, it'll fit our benchmark. That's not the kind of morning you want to see if you think we're going to rally. It just came to mind. I should have caught this sooner. On an OpEx day, even though this isn't OpEx for futures, on an OpEx day, we can sometimes get a market maker move, even though there's no hedging. So let's just come in here real quick and see. Yeah, okay, they're hedging it. It's not fake. Should have caught that sooner though. If this was an OpEx that was going to also be for the futures, which it's not, but if it was, then we would want to make sure that we were actually seeing a market maker move because of hedging and not because of expiring options. We're actually getting hedging in here, so it's not that. But if we don't look, then we can't say for sure. Yeah, they're hedging. Gold miners, that breakout just failed miserably. Nat gas, banks, after they made that spectacular breakout, kind of giving a little bit of it back. I don't think there was any news out of China last night that would account for this necessarily. But I mean, it was a very busy news cycle this morning. So there could have been. I didn't get a chance to digest everything. So I don't know. We were definitely down this morning on the China side. China ADRs, Baba, Baidu, JD, PDD, all that group. And with the dollar up, it would make sense that we're going to see gold down, precious metals, that sort of thing. Doesn't seem like it's up very much. 0.13. That's not much. But take it in the context of this entire move, and then you can see that we're up a bit more, right? It's 0.68 from the low. And we're back above 104. Remember, nowadays we got to use like swag levels, benchmarks, lines in the sand, 104 and above. That's going to put pressure on the S&P, the NASDAQ. Below 104, that would be less pressure on the S&P and the NASDAQ. Generally. The 10-year also, since that low of Wednesday, marching to the upside. Gold may be the better play today. Certainly crude is range bound at the moment. Wait on news. Keep your eye on the market maker move. See if it's continuing to increase. If it starts to decrease, then we're beyond the event, whatever the event happened to have been. watch out for the Fed speaker. As we get past that, we should be free and clear into the afternoon. Should have a nice opportunity for a 0-day trade at that point. Be careful, be safe. I'll see y'all next week.